Have you ever wished you could increase your stock market profits without taking on the excessive danger to your capital? Do you want to increase your profits by utilizing transient trends? You might be interested in leveraged ETFs if you indicated yes to these questions. Leveraged ETFs might be the answer to boost your returns and spice up your trading strategy. But before investing in them, ensure you understand how they work, the benefits and drawbacks, and how to use them wisely. Welcome to Luxo-Life, your partner toward personal growth and success. This is the third video in our ETF series, and here we'll focus on what leveraged ETFs are, what they can do for your portfolio, and what are the benefits and risks that come with. Let's get started. Exchange-traded funds that use financial derivatives and debt to boost the returns of an underlying index or benchmark are referred to as leveraged ETFs, geared ETFs, or inverse ETFs. They are designed to provide investors with a way to magnify their gains or losses in a particular market, sector, or asset class. But what exactly can leveraged ETFs do for you? Leveraged ETFs may be a powerful tool for traders profiting from market volatility and short-term fluctuations. They can also help with market risk management and portfolio diversification. Yet, they are not for the faint of heart. Leveraged ETFs feature higher expenses, risks, and potential losses than traditional ETFs. While they require constant monitoring and balancing, they worsen over time due to compounding effects. An investor may, for instance, buy in a leveraged ETF that seeks to deliver 2 or 3 times the index's daily return if they wish to acquire exposure to the S&P 500 index. As a result, the leveraged ETF would try to grow by 2% or 3% if the S&P 500 rose by 1%. In contrast, the leveraged ETF would attempt to decline by 2% or 3% if the index fell by 1%. Aiming to deliver the opposite return of the underlying index, inverse ETFs operate oppositely. For instance, an inverse leveraged ETF that attempts to produce 2 or 3 times the inverse return would aim to grow by 2% or 3% if the S&P 500 declines by 1%. How, then, do leveraged ETFs produce this boosted return? They employ financial instruments to obtain exposure to the underlying asset and raise the investment amount, including futures, contracts, swaps, and options. With this borrowing, the fund can enhance its exposure to the underlying asset above and beyond the amount of cash in its portfolio. Let's imagine, for illustration purposes, that a leveraged ETF with $100 million in assets wishes to generate a 2 times leveraged exposure to the S&P 500, which is now trading at $4,000. The fund could increase its borrowing to $200 million and utilize that sum to purchase S&P 500 futures contracts, doubling its exposure to the index. The leveraged ETF would have made 2% or twice the daily return on its $200 million investment the next day, translating into a profit of $4 million if the S&P 500 rose by 1% to 4,040. Although the fund would also have to pay interest on the $100 million borrowed, this would lower the overall return. Investors seeking to increase their returns from a particular asset or index may find leveraged ETFs advantageous. Furthermore, they can be applied to short-term trading plans or as a hedge against market downturns. Leveraged ETFs do come with some serious dangers, though. There are 2 types of leveraged ETFs. The first one, called bullish leveraged ETFs, seek to boost returns for a particular market or industry. These funds give investors leveraged exposure to the underlying assets they follow by using financial derivatives like options and futures. They are intended to provide returns generally 2 or 3 times the daily returns of the market or sector they monitor. The second, you guessed it, bearish leveraged ETFs. Investors and traders who wish to profit from a downturn in the market or a specific asset, or protect their portfolio from downside risk, frequently employ bearish leveraged ETFs. It's crucial to remember that these ETFs are created to offer daily returns so that long-term returns may differ dramatically from short-term gains, particularly in times of market volatility. Leveraged ETF investment, risks and rewards. Leveraged ETFs can provide investors with more significant returns than ordinary ETFs, but they also carry a higher level of risk. The following are some of the main advantages and hazards of investing in leveraged ETFs. Leveraged ETFs strive to magnify the returns of the underlying index. Therefore, they have the potential for more significant returns than standard ETFs. Leveraged ETFs can expose investors to various asset classes and industries, allowing them to diversify their investment portfolios. Why should you be careful when using leveraged ETFs? Leveraged ETFs are used. Investors seeking to increase the returns and take advantage of market volatility and short-term trends may find leveraged ETFs appealing. However, you should know these dangers and disadvantages before investing in them. Leveraged ETFs include several risks, including the potential to magnify losses and gains. You risk losing more money than initially invested if the index or asset moves contrary to your expectations. For instance, you would lose 3 times your investment, $3,000, if you invested $1,000 in a 3x leveraged ETF that tracks the Nasdaq 100 index, and the market fell by 10% in a single day. Leveraged ETFs have the drawback of being unsuitable for long-term holding or investing. Leveraged ETFs are created to follow an asset's daily performance rather than its cumulative or yearly performance. After each trading day, they reset their leverage and exposure, which can have cascading impacts over time. Over several days, weeks, or months, compounding effects reduce your returns or increase your losses. But despite all of its cons, why buy leveraged ETFs? Leveraged ETFs provide the potential for greater returns than standard ETFs or individual equities, which is one motivation to purchase them. Leveraged ETFs can help you take advantage of short-term market trends or movements if you strongly believe in them, increasing your returns. Leveraged ETFs can expose you to several industries, geographic areas, or commodities, which can help you diversify your portfolio and protect you from market risks. Leveraged ETF purchases have the advantage of not requiring account maintenance or margin borrowing. Leveraged ETFs do not force you to pay interest or other fees on borrowed funds, unlike margin trading, which borrows money from a broker to purchase more stocks than you can afford. Also, if the market goes against you, you won't have to fulfill margin requirements or answer any margin calls. You simply have to pay the fund's expense ratio, which is typically less expensive than the price of margin trading. Compared to standard ETFs or individual equities, leveraged ETFs are desirable investing solutions with various benefits. They have a wide range and are inexpensive, tax-efficient, liquid, and adaptable. Also, they provide the possibility of more significant returns without requiring margin borrowing or account upkeep. Before investing in them, one must carefully consider their dangers and disadvantages. They could be unsuitable for long-term investors and have tracking inaccuracy, more outstanding trading fees, volatility, and smaller payouts. Hence, before selecting a leveraged ETF for your portfolio, you should conduct your homework and understand your goals and risk tolerance. Leveraged ETFs are a double-edged sword that can enhance your returns or worsen your losses in the stock market. One method to utilize leverage is through leveraged ETFs, although not everyone should use them. These assets demand continuous monitoring and rebalancing, since they are hazardous, complicated, and volatile. They are only appropriate for seasoned investors with a high risk tolerance and a thorough grasp of their operations. Do your homework, diversify your holdings, and use prudence to invest in leveraged ETFs. We appreciate you watching the video about leveraged ETFs. I hope that was instructive and useful to you. Recapitulating, leveraged ETFs are funds that boost their returns through borrowed funds or derivatives, which might appeal to investors looking to take on more risk in search of greater rewards. You should research leveraged ETFs and speak with a financial expert before investing if you're interested in discovering more about them. Watch some of our other investing and personal finance films for further advice and ideas. Once again, thanks for watching. Please like, comment, and subscribe to our channel for more great content.